Can we quickly revise once? Come to page 282. Yes, let's start. First section is liquidity ratio. There are 4 ratios. First one is current ratio, which is current asset divided by current liability. For trading and manufacturing entities, ideal current ratio is 2:1. Not for service industries, because service industries don't carry inventory or stock with you, and most of the time half of your current asset is inventory itself. That is why the next ratio is liquid ratio, where you do current asset minus stock, which is called quick asset divided by current liabilities. And ideally, even this number should be greater than 1:1. That means current asset minus stock, which is liquid asset, should be greater than 1 when you compare that with current liability. Third one is absolute liquid ratio. Here you don't even consider debtors, advances, deposits, etc. You take only cash, bank, and temporary or marketable securities, where by click of a button you should be in a position to convert that to cash. That you divide by current liabilities. Next one is basic defense interval. Here again same numerator, cash, bank, and marketable security. You divide that by daily cash operating expenses. If this number is very high, tell me what does that mean? You can survive for that many days even without collecting a single rupee from your customers. Suppose this total is 10,000 and this daily cash requirement is 1,000. That means you can survive without collecting for next 10 days. If this number is high, shouldn't be too high also. Too high indicates you have kept a lot of money in hard cash or bank balance or marketable security, which won't earn interest. But if it is above 10, 15, 20, 30, that means you can survive a month full without collecting even a single rupee from your customers. Situations like lockdown will make us think about these kind of ratios. How long can I survive without collecting money from my customers? So next, long-term solvency. When the heading itself is long-term, here if I say debt, I'm referring to long-term debt. Right? This discussion is about long-term funds. First one is shareholders fund. By default in financial management, when I say shareholder, it is equity shareholder. When I say share capital, it is equity share capital. If it is preference, it should be specifically printed in the question, which means this is basically share capital plus reserves and surplus minus if there is any fictitious asset, correct? To be divided by total capital employed. Tell me what is included in the heading total capital employed? Shareholders fund plus debt, and since I'm discussing long term, this is long term debt, which is debentures, bonds, bank loan. If you see a loan in the balance sheet, you have to check whether it is short term or long term. Don't take every loan. If the word is term loan, it is for a longer duration. If you see short term loan, if you see bank overdraft, if you see cash credit, these are all short term loans. Next one is debt, total debt divided by total capital employed. Since the heading is long term, the total debt should be understood as long-term debt. It can be both long-term or short-term. But because we are discussing long-term ratio, this should be understood as long-term debt, which is bonds, debentures, and bank loans, to be divided by total capital. Debt equity, total debt divided by shareholders fund. If this number is 2:1, that means out of 3 rupee, 1 rupee is funded by owners, 2 rupees funded by outsiders in the form of debt. Next, debt to total asset ratio. Total debt divided by total asset. Let's put some numbers. Assume this is 10,000 and this is 6,000. When you do into 100, you get 60%. What is the meaning of that? 60% of the total assets are funded by debt, which is outsiders, which means the balance 40% should be funded by owners or equity, and that is there in the next page. Proprietary fund divided by total asset. If total asset is 10,000, proprietary fund, example 4,000 into 100, 40% of money is funded by equity shareholders. Coming back, capital gearing ratio, easy way to understand. In numerator, you have two funds where the returns are to be paid at fixed rate. One is debt, second is preference share capital. To debt, you are promising fixed percentage of interest. Here it is fixed percentage of dividend. To be divided by equity shareholders, here how much you're going to pay at the end of the year is flexible. That means numerator is fixed fund divided by denominator is flexible fund. Fixed fund is debt and preference share capital. Flexible fund is equity shareholder. 1 year you may pay more dividend, next year less dividend, next year you may not pay any dividend. That's why I use the word flexible fund. Next, coverage ratios, something that banks check. The first two ratios, one is debt service, second is interest service coverage ratio. When I say debt service coverage ratio, they consider entire EMI amount, which is principal component as well as interest component. How much is the money that you are earning, which can be used for servicing the debt, divided by interest and installment. This word is interest plus installment, but you know in some books installment includes principal and interest. So this should be understood as interest plus principal also. Basically, the money that I need to pay to the banker, say EMI. If EMI is say 15,000 rupee and amount available is 30,000, then debt service coverage ratio is 2 times. Banker knows you are earning 2 times of whatever you are supposed to pay them, and 1.5 to 2 DSCR is considered to be satisfactory. Banker will not give you loan if it is 1:1 because it is high risky from banker's perspective. This is entire debt servicing. Next formula is only interest servicing, where they will check whether you have the ability to at least pay interest. Here you do EBIT divided by interest, because if you are earning EBIT of 8,000 and if interest is 6,000, the number will be greater than 1. That means you are earning more EBIT than the amount of interest to be paid to banker. If it is less than 1, then you are not earning sufficient EBIT to pay the interest. It is company's headache now to arrange fund from some source and pay the interest, but it is risky for the banker who has given loan that you are not earning EBIT enough to at least pay interest amount. Next one, preference dividend coverage ratio. This ratio is checked by preference shareholder. The one who wants to become preference shareholder in your company will check how much is the PAT or EAT that you are earning divided by preference dividend. If preference dividend is 3 lakh rupee and you are earning 3 lakh 1,000 rupee example, that means he now feels safe that you are earning whatever is supposed to be paid to him. That's why more than 1 is considered to be satisfactory. What if this is 201,000? He will get full 201,000, but that is not enough. For 99,000, he'll have to wait, because by default, all preference shares are cumulative in nature. That means you don't want to by default invest in a place where the dividend coverage ratio is less than 1. Next, activity ratio, efficiency ratio, performance ratio, or turnover ratio. One common thing in all of this is these are measured in times. Higher the number, better the indicator. First one, total asset turnover, next fixed asset, then current asset, then working capital, then capital turnover. Easiest way to understand this, everywhere turnover is the numerator divided by whatever is there in the left hand side. Name itself tells you what should be the denominator. If you are doing total asset turnover, it is total asset. If it is fixed asset, divide by fixed asset, and so on. Tell me all these numbers are in times. Higher the number, better the performance. From 1 rupee total asset, how much is the turnover? From 1 rupee fixed asset, how much is the turnover? 1 rupee current asset, how much is the turnover? And every business wants it to be higher. There is nothing as standard 3:1 or 5:1. Higher the number, better the performance. So then how will I decide whether this company is good or not? Compare that with other companies' turnover ratios. Next, these three ratios are related to specific current asset and current liability. Inventory turnover ratio, COGS, or turnover by average inventory. I've told you repeatedly, this is the only formula where COGS is first. If that is not there, only then you use turnover divided by average inventory. For that, they should give opening and closing. If they don't give opening, you take it as closing. Correct? Tell me if this is 10 times, what does it mean? This represents what? Speed of movement of inventory. If you do 360 days by 10, 36 days, that is the time period for which you are keeping inventory with you. If 10 becomes 20, then 360 by 20 will become 18. That means you're keeping inventory with you only for 18 days. Higher the number, lesser is the period for which you keep the inventory. Indirectly saying inventory is moving very, very fast. Correct? Apply same logic and tell me for debtor turnover ratio, if the number of times are increasing, what does that mean? That means you're collecting money very fast. If this is 10 credit sale by average debtor, then in a year you collect 10 times from your customers. So 360 by 10, it says 30, it will be 36 days. That means once in 36 days you are collecting. If this becomes 20, then number of days will be 18. That means you are collecting within 18 days. Lesser the number of days, faster the collection. Same logic even for creditor, but here it is not about collection, it is about payment. If this number is very high, that means you are paying very fast. Maybe you want to maintain good relationship with your supplier, or you're going to get some cash discount if you pay early. Maybe that is the reason why you are paying very fast. Paying fast is not wrong. Don't say that if DTR says collect early, CTR should say pay late. That's not always the correct logic. You want to maintain good relationship with both customers as well as suppliers. Next, profitability ratios. Number one, GP, very simple. GP by sales into 100, NP by sales into 100. Only when you are talking about net profit ratio, you have to check whether in question they're asking pre-tax or post-tax. GP will never be pre or post because we always know GP is much above tax. Only NP can be pre or post. Some books do PBT, profit before tax by sales. Some books do PAT by sale. If question is silent in exam, you do both and come. You write NP ratio in bracket pre-tax, work out. NP ratio post-tax, you work out. For one you take PBT, one you take PAT. Correct? If tax is 0, then PBT itself is PAT, then you don't have to show pre-tax and post-tax. Next is operating profit. Here what happens? Net profit can go up or come down because of non-operating activities as well. If I am running a hotel, whatever I earn from hotel related activities is my operating activity. I had extra money, I invested in a software company share, from there I got dividend income. That dividend will go and sit in the credit side of P&L, my NP will go up, but that is not representing my correct performance. Therefore, I should go by operating profit and not net profit. Operating profit by sales into 100. This is the indicator of operating effectiveness or efficiency. This is not the perfect measurement all the time. NP is not the correct measurement. Operating profit is a better measurement. Here you take out all the non-operating activities. Next one is return on investment, which is profit that you earn divided by investment, the money that you have put in into 100. Now this return on investment can have different variants, different varieties. Here it can be return on asset, return on capital employed, return on equity. First one is return on asset, wherein you do PAT, add back interest divided by average total asset. First of all, this adding back interest, remember, PAT comes after you pay taxes, and that is after paying taxes, paying interest. That means you would have started from EBIT minus interest, EBT minus taxes, you get EAT. But that EAT is not taken here. You add back interest. First you deducted interest to calculate correct taxes. Now we are adding back interest because interest is a non-operating activity. This is a financial activity. Therefore, you come down till PAT and then you add back interest that you divide by average total asset. For average, you need both your balance sheet. If that is not there, take the closing total asset. Done. Return on capital employed, very important. This is useful even in other topics. EBIT, this is profit before all adjustments. No interest, no tax, no preference, no equity dividend. This is pure profit coming from sales minus total cost. Right? EBIT divided by total capital employed. This is both debt as well as equity, that is shareholders fund into 100. Return on equity, if I am an equity shareholder, I am more concerned about what I am going to get than what company has earned. There is a difference. Company has earned EBIT, but as an equity shareholder, I won't get to enjoy EBIT. I have to pay interest, taxes, and preference dividend. That means whatever is available to me, earning available to equity shareholder divided by equity shareholders fund into 100. Now again, fund means capital plus reserve. Remember, when company keeps reserve, that money belongs to same equity shareholder. And why did they keep the reserve? To reinvest. That means it is not only your share capital, plus even that reserve is reinvested in the business. From the total capital that is invested in the business, how much is the earning that is available to equity shareholders into 100. Next, this return on equity is explained in a detailed model called DuPont model, which is a combination of 3 factors. 1, net profit. 2, asset turnover. 3 is equity multiplier. In equity multiplier, you will get to know out of total money that you have given to the company, how much of that has gone to procurement of asset. Balance would have gone for day-to-day expenses. From that asset, how much is the revenue or turnover that they have generated? From that turnover, how much is the profit that they have generated. Actually, when you multiply all of this, revenue and revenue, asset and asset will get cancelled. Ultimately, it is net income divided by shareholders fund. It is what you get divided by what you have invested. But you should not always check just the return on equity, that is ETH divided by shareholders fund. You have to see three factors. One, equity multiplier, out of total money, how much is invested in asset. Second, asset turnover, from the asset, how much is the turnover generated. Third, from the turnover, how well they have managed the cost and how much of profit they have generated. Ultimately, when you cancel asset and asset, turnover and turnover, what is left out is profit divided by initial investment into 100. That's next. Debt equity ratio, what is it about? Debt equity ratio is 2:1. That means if company requires 3 rupee, 2 rupees should come from debt and 1 rupee should come from owners. Now I know, sir, then are you suggesting companies should run with more debt? Answer is yes. From today we have 15 days to learn this. Yeah, whether debt is good and why more. It can be 1:1 also. Even if debt is good, it can be under control. We are suggesting more debt and less equity. That means if your business is 100 lakh, 66 lakh from debt, only 33 owners money. This comes with lot of risk also. 66 is a very big number out of 100. What is the advantage of having so much debt? We will learn in risk and leverage topic. What you are seeing is so much of risk. And if we go to that topic, we'll also see what is the good thing of that risk. Coming back, where are we now? Next segment is profitability ratios required for analysis of from owner's perspective. Owner is again equity shareholder. First, EPS, that is earning available to equity shareholder. This is the last item in your income statement. Earning available to equity shareholder, you divide that by number of equity shares on the last day of financial year. This will give you earning per share. This is in rupees. Dividend per share, from earning available to equity shareholder, some money will go to dividend, some money will go to reserve. So this dividend money, divide this by number of equity share. This is also in rupees. Then when you do dividend per share divided by earning per share into 100, and you multiply by percentage, multiply by 100, you get dividend payout ratio in percentage. If a company has earned 10 rupee EPS but paying only 7 rupee dividend, 7 by 10 into 100, 70% is dividend payout ratio, which means 30% should be understood as retention ratio. Right? Last set of ratios is related to share market dividend yield ratio. Dividend per share divided by market price per share. Suppose the company share price today is 230 rupees. This is what I have to pay to purchase. End of the year, I am going to get say 15 rupee dividend into 100 when I do in percentage. Any return, remember, yield return is always in percentage. So this tells me how much is the annual return that I'm going to get. Here we are not considering increase in the share price. We are only considering the dividend amount that you're going to earn. Second is EPS divided by MPS into 100. Similar to previous formula, but instead of checking only dividend, you are checking entire earnings. Slightly broader than dividend. Price earning ratio is exactly opposite of earning yield. Here it is MPS by EPS, but you're not doing it to 100. So this number comes in times. If this number is very high, then understand people are ready to pay very, very high price for a share that is giving X rupee of EPS. Say 1 rupee. If P ratio 72, that means to earn 1 rupee EPS, people are ready to pay 72 rupee. Last one is market value, book value ratio. This is also called as price to book value ratio, P/B. This is how we will get to see practically P/B, price to book value ratio. And this is market price divided by book value. Suppose a share today is getting traded at 1400 in stock market. If you check their balance sheet, you'll get to know its book value if it is 10. And 1400 by 10, 140 times is price to book value ratio or market value book value ratio. Done. This is the summary of all the formulas that we have in this chapter.